Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
To me, there's a lot of relevancy by what you did in Kingsway. One of it is like, it is not easy to invest in Pakistan or Bangladesh. Just, you can't buy it on your phone, right? So market access is something you learn, complicated market access. How the fuck do I do this? Often in weird instruments because there's no other way of doing it for FDI reasons.
Yes.
Then you're dealing with, as you say, currencies that are complicated and economies and governments that are complemented, that rug pull you all the time, that things happen.
Yes.
And then you've got this thing that you're dealing with small growing economies that are trying to learn as they grow. And to me, that is the entire crypto world. How difficult is it to get market access?
Crypto is the frontier market.
It's a frontier market. It's all, and I've written a lot of pieces about this, as how I think about the crypto economy and the sub-economies within it. They're all frontier markets. Right. Some are larger than others. So we call them emerging markets plus frontier markets. We've got this problem of market access. We've got the same complications of governance. Yeah. We've got, all of the shit that you've gone through.
Exactly.
We complicate it because it's all digital and claim it's all different. It's not. It's the same stuff. It's building small economies and businesses in these highly volatile economies. That's what we're doing.
Absolutely right. And I guess you put it really well. I mean, this is maybe, what did Elon say? In hindsight, it was inevitable that I would end up in digital assets, given, that this is just a logical extension almost. But also, frankly, I'm really mission driven about this as well. Like, I've seen a lot of poverty in my life. Sadly, this is not a joke. Like, this is a human rights problem. I was at the Oslo Freedom Forum last week. Actually, Pavel Durov gave a very passionate speech or interview that is online. And, I've come to the conclusion, right, that people aren't poor in these countries because they're lazy or stupid. Because in my humble experience, most of them are not lazy or stupid, right? They're poor because they've only got labor working for them, not capital. And there never is any true capital formation because the little money they make from their labor, there's no place to put it other than fiat currency cash of the worst kind, not even interest. And so it's a pretty big deal that for the very first time in human history, the poorest people in the world can choose and are choosing the same stores of value in cyberspace that the richest people in the world are choosing. Starting with the US dollar, stable coins, massively popular. But, of course, Bitcoin, and then you go down the list, right? And so that is new, and it could make a massive dent in poverty reduction, financial inclusion, economic empowerment, and I'm here for it.
Sorry, I had a lot of charts in this pack.
Really, that's surprising. You generally are quite light on charts.
I know, which I think then stacks up with this, right? Because this is not, Global M2 here is not updated for the dollar's recent move higher. And I actually think the dollar may head a little higher here. I'll show you that chart in a second. But if that's right, then this top bit in Global M2 will come lower and should set us up for that corrective phase, which that other chart also matches. And as I pointed out in MIT,
but financial conditions leads M2, right?
Financial conditions leads M2, but here you're talking about the rate of change versus, remember, it was that whole thing of the everything code dominoes. There's a bit of a difference in the lead versus rate of change versus outright. And so basically here they would line up to say around August, we should see something, but we have to see, right? It really depends on what the dollar is doing. Because if I just shift,
but we're expecting financial conditions to continue to ease, right? Because we think there's another leg lower in the dollar. We think rates either stay flat or move lower.
Yeah, so that's right. So, but if we just skip back up here, I'm going to come back to the dollar. Where are we here, right? So we're coming lower. Obviously, yesterday we moved a little bit higher, but I think that ultimately the trend's lower. But I also think over the next, if you look at, guys, I'm just going to change screens here. That's all right. To Bloomberg. If we look at the dollar here, right? I mean, we've counted down to wave 5 and we had a 913.9. And this is basically where you and I were like, this is going to go higher. The chart's not on the screen, is it? No, it's off.
Yeah.
Okay. Is it? there it goes. Now it's back.
Yeah.
Then it came lower, and then we unlocked a wave 2, or now we've unlocked a wave 3 of potentially 5 higher. I don't know if that plays out, but you can see that the counts are all stacking up here pretty heavily. So in the event that the dollar does move higher to, let's call it 104, which DMARC wave count suggests, which seems a bit high to me, but nevertheless, this would unlock that corrective period.
Which is looking like August into September, maybe. We don't know the length of it yet.
Yeah, so that's why I was saying at MIT, the next move in the dollar is going to tell us everything that we need to know about, the ISM, when that peaks out, everything else. But I think whether this goes higher or not over the medium term, not even medium term, I should say over the short term, we still think it goes lower. The other thing I was just going to point out,
which sets us up for phase 3 of the banana zone. So phase 2 correction would be this. If it continues to trend sideways or a little bit stronger, that would be a corrective phase when everyone starts thinking it's all over, we'll give up now. And then we should get phase 3, which is the final leg in the dollar, potentially a leg lower in rates, and the more speculative frenzy that comes at the last part of this.
We've had these periods where global liquidity goes sideways, and actually Bitcoin usually tops before global liquidity tops out. So it's
like when the rate of change of global liquidity slows down, it starts topping.
Yeah, because this has been driven by, in the past, a lot of central bank activity as well. So central banks move very, very slowly, but the market detects when when break-even starts to break high, the market starts pricing in higher inflation, that the central banks will have to pivot. But they don't pivot on a dime unless it's an emergency when they're adding liquidity, but never when they're withdrawing. So usually Bitcoin will sniff it out many months in advance, and we'll see the top form, and then global liquidity will roll over. But the contraction periods in global liquidity traditionally have only been sort of 24 months, so 2 years. And that was in 2014 and 15, then in 2018 and 19. The one that we've just gone through has actually been 3 years. So to your point earlier about the cycle being elongated, if you look at global liquidity here in white, it's been it was down sharply in 2022. And then we just had this sort of contraction period, like a wedge pattern that we've sort of been squeezing into and now breaking out of. So a longer contraction.
Buying that low in the first, that's what we did. And it worked really well. Back end of 2022, when global liquidity, it doesn't give the strongest price action, but I don't know, Bitcoin's up 6x since then. So it does work just by getting the bottom of it. But the breakout is when it really counts, right?
Yeah. So the tops are harder, but the bottoms are easier actually, because, at the bottom, it's usually sharp central bank actions. And that's the signal. You sort of don't have to sort of second guess that. And now that we're starting to break out, and you look at the sort of breakout of the last contraction period, and obviously 2020 was exceptional, so we're not looking to repeat that. But generally, if you look at the previous times we've gone out of a contraction period, that has been what I define as like the super bullish liquidity regime. So, global liquidity can only contract or go sideways for a certain amount of time because the whole system is so indebted that their default risk rises. And also just the interest cost on debt becomes too excessive. So there's always an impulse to add liquidity. And so like a beach ball under the water, if you keep it down for too long, it's going to burst out, and we're starting to break out now. And so in the past, when we've seen a breakout of the previous all-time high in global liquidity, Bitcoin's sensitivity to the changes in liquidity triple at least. Sometimes 4 or 5x. So
wow.
in my analysis, global liquidity goes up by 1%. Bitcoin usually rises about 7%. But in these particular regimes, that goes to 20 to 30 times. So a multiplier of 5. And what's really interesting is that we got the breakout in global liquidity in early April as the markets were sort of tanking. So that was this low that we went through, which really wasn't much to worry about, like in terms of Bitcoin pullbacks, but it felt pretty nasty at the time. Massively outperformed the S&P, massively outperformed the equities on a volatility adjusted basis, even though, it was down 30% and the S&P was down 20%. On a risk adjusted basis, massively outperformed equities. And so when it broke out, when global liquidity broke out in early April, Bitcoin rallied 40%. Global liquidity from that breakout is up about 2%. That's roughly what it has done in those previous bullish regimes where global liquidity breaks out to new all-time highs. You get a sensitivity factor that is multiples, factors higher than it typically is. And so for me, it's interesting that, we're not overbought, based on liquidity. Every new dollar that's created, whether it's even through like the US dollar weakening or depreciating, is an easing on financial conditions, it all adds liquidity into the system or makes financial conditions better, and the relationship is strong. And so, I'm looking at now a market that is not overheated at all. In fact, it's doing what it should be doing, and it's not doing anything excessive. So I talked about a framework for sort of modeling the risk. What I did was I converted that relationship into a risk score. And the risk score for global liquidity is just this one here. It correlates pretty well to the tops in Bitcoin. So what you want to see, it's a rating system of 1 to 5, but I've also got percentiles, and we'll be publishing them onto the RV platform. So if people want to get a little bit more granular, like if we're at a 4, does that mean we're at 82nd percentile or the 88th percentile, the 90th percentile? We'll get that granularity shown as well. But what it's designed to do is to say, okay, anything below a 4 is sort of just neutral, normal conditions. When we're at 4s, you have to start thinking about, okay, if there is chips to be taken off the table in Bitcoin or crypto.
And this is not necessarily the full cycle top. It can be sub-cycles within, right? Because I'm looking at got to 5s a couple of times, backed off again. So you kind of use it like a weekly RSI kind of idea, is like an overbought, oversold indicator.
Yeah. So what you said is like perfectly correct. It's like you've got to use it with some context. Like an overbought RSI at the beginning of a breakout of a long-term downtrend is not a sell signal, it's a buy signal. But this is a little bit more calibrated to knowing when things are really stretched relative to the one the one statistical relationship which really seems to matter, which is liquidity. So if it becomes extremely stretched versus liquidity, even in a mid-cycle scenario like we saw in early 2024, so we got that read when Bitcoin was around 51, 52,000. It topped, within a week or two at sort of 73,000. So it doesn't catch the top. None of these are going to catch the top, but it tells you when global liquidity, when the price is stretched versus global liquidity. And of course
that's how I think about this to explain to people is call it a 90% correlation roughly. It's when you look at what's the other 10%, it's often the fear and greed, the elements where the market gets over ahead of itself, which is what you're picking up here, is like the deviation from the trend versus liquidity, right?
Yeah.
So when it gets too obscene, people have taken too much risk. And then you've got other scores like leverage that then you would add on to that and say, yeah, and the leverage is built up and that's why we're in excess.
Yeah, exactly. So like I probably should have said this from the outset. It's global liquidity, it's leverage and positioning, and it's unrealized profit. So when you get the confluence of those things,
it's broader than just deviation from liquidity.
Yeah. And that's important because that tells the other side of the story. So, okay, you can say that, okay, it's stretched in terms of where it is relative to global liquidity, but is there excessive leverage in the market? Like if that is also happening at that time, boy, oh boy, do you have a very strong signal for a looming market top, because derivative like open interest and the factors that go into the leverage component of the derivatives risk score are very finely tuned to tops and also bottoms. So that plus also unrealized profit, which you can see on chain, come together in a very good way, like in terms of the confluence that you can get from it to give you sort of high probability zones of when things will top and bottom as well. So this was indicating, that in the early part of 2024, just a couple of weeks before we had that top, which I'll show you with the next chart on the derivatives one, was really driven by the derivatives market. It just was so excessive in Q1 with the launch of the ETFs that it was, it was destined to correct. It only corrected by 25, 30%, a pretty normal correction, but it did take about 6 to 7 months to unwind all that positioning. And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 to 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal, the normal relationship playing out.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.